Well, let's go to our first conversation this afternoon. Now, in a major policy move aimed at strengthening Nigeria's banking sector, the Central Bank of Nigeria has issued a new directive mandating banks to submit a capital restoration plan by mid-2025. This is part of the broader strategy to exit the regulatory forbearance regime, a temporary relief structure that had allowed banks to operate with relaxed rules during tough economic times. In a circular signed by the Director of Bank Supervision, Dr. Olubukola Adewumi, published on its website on Monday, the Apex Bank said the capital restoration plan would not complement its other measures, which includes termination of forbearance exposure and single obligor limits, waivers, suspension of payments of dividends, bonuses, and investment of foreign subsidies for affected banks. Now, what is the capital restoration plan? What is the capital restoration plan? Is a formal roadmap that banks must develop and submit to the CBN. It outlines how a bank plans to return to full financial health, specifically how it intends to meet all regulatory capital and assets quality requirements. In simpler terms, banks are being asked to show how they will clean up their balance sheets, reduce risky assets, manage costs, and more efficiently, and adjust their business models if needed. The CBN has set a deadline starting from June 30, 2025. Banks must submit these plans within 10 working days after the end of each quarter. Let's talk to the Group Managing Director and CEO of Kari Assets Management Limited, Mr. Johnson Chukwu. He is my guest for this conversation. Good afternoon, Mr. Chukwu. It's good to see you today.
Good afternoon, Tolu. Thank you for having me.
Yes, I'm sure you saw, I tried to make a bit of explanation of what the capital restoration plan means. But I think I'm going to throw that to you again to help us understand it better. What does that capital restoration plan what does it really mean? And adding to that, would we say our banks before now had not maintained maybe strong transparency in their dealings?
Well, let me start from what a capital restoration plan means. Just like the word restoration, it simply means that the banks are required to put back their capital in a position that meets the regulatory capital and the prudential guidelines. That the bank's capital must be restored back to the levels that are stipulated by regulatory authorities, by the central bank, under the prudential guidelines and every other regulatory capital. In simple terms, they were forbearances that were granted to banks, and that the central bank said they are pulling back those forbearances, that those forbearances have elapsed. And the banks now need to meet the capital requirements as if there were no forbearances. Let's take, for instance, the issue of forbearance that were granted to banks as a result of COVID. During COVID, most businesses were shut down, businesses were not running, so customers were not able to meet their obligations to the banks. So the central bank allowed banks not to provision loans that were not being paid back. Requirements under the prudential guideline is that if a loan is outstanding, is due for payment and is outstanding for 90 days, it's classified as not substandard. Then after that 90 days, that's 180 days, classified as doubtful. And then if it's not performing for 360 days, it's classified as lost. So the banks were allowed not to make those classifications, to carry those loans as if they were performing. Because when you classify them, you have to make provision. The prudential guideline requires a particular percentage of provision that you must make, including what they call general provision, which is 1% of your total loan books. And then if a loan is substandard, there is a percentage provision you have to make. A doubtful, you have to make a provision, and then a loss, you have to make 100% provision for that loan. So because the central bank allowed them not to classify those loans, so that was a forbearance, allowing them not to classify the loans that were not being serviced. So that's one aspect. So the central bank is saying now you need to go back and meet the requirements of all loans. That's all loans must be performing. They're not performing, you have to make provision for them immediately. And that's one of the things, forbearance that have been withdrawn, which is saying that, look, in that case, you need to bring back your capital base, because when you make provisions, you erode your capital, and your capital may no longer meet the regulatory capital. Then the other forbearance that is topical is a forbearance that was granted as a result of the movement in exchange rates. When Naira depreciated last year, June last year, June 2023, not last year, June 2023, after the government harmonized the exchange rate, the central bank came up with a forbearance that said to the banks, because the value of the loans have inflated because of the change, particularly dollar-denominated loans. If you had a loan of $1 million that was initially valued at 420 million naira, that $1 million loan had become 1.5 billion. So some of those loans exceeded 20% of the shareholders' funds, which is what they call single obligor limit. That the maximum amount a bank can lend to customers is not more than 20%. A single customer, a group of customers, should not be more than 20% of the shareholders' funds. So when the value of the loans increase above the 20% of the shareholders' fund, central bank granted banks forbearance and said you do not have to make provision for that, or you do not have to either raise additional capital to bring that loan under 20% of your shareholders' fund, or get the loan to be paid down because those loans had become stick and they couldn't be paid down because the customer didn't have the money to pay back. Central Bank is saying now that that forbearance has now been withdrawn or elapsed, and the banks either have to get those customers to pay down to below the single obligor limit or increase their share capital to accommodate that size of loan. So those are the two things, some of the critical factors that the central bank is saying will pull back, and there you need to restore your capital to meet the regulatory capital. And when you ask, does it mean the banks are not transparent in their disclosure? No, these were granted waivers. It's just like tomorrow, Tolu, your wife gives birth, and TV says, okay, Tolu, you know what? You can come to work. Instead of resuming at work by 10 a.m., by 8 a.m., you have to resume at 10 a.m. because we know you are babysitting with your wife. So we know you won't have had enough sleep at night. So we give you 2 additional hours to get to work. And then maybe after 6 months of babysitting with your wife, the TVC now says, Tolu, that forbearance has elapsed. That waiver we granted has elapsed. You have to start coming back, resuming work at 8 a.m. So that's it. It doesn't mean that time when you're coming to work at 10 a.m. that you are not being transparent. It just means you're enjoying some level of accommodation that was granted you by your employer, in this instance by your regulator, central bank.
Great stuff there. I like that understanding, because I think most of this happened during COVID-19 when there was devaluation and, of course, sluggish economic growth. I think that was when all of these waivers were granted. But the risk management in our banking system, what do you make of how well banks are managing risks generally with regards to loans and all of that?
What I would say is that there's been a lot of improvement in risk management. I think Nigerian banks have a better understanding of risk management, unlike what used to happen, probably that led to the financial industry crisis and the banking industry crash that we witnessed in 2008, 2009. But then, in appraising risk or in managing risk, you have you have specific corporate risk or entity risk. So you're looking at this particular entity, you're appraising them, and you are assessing their riskiness or their credit rating. So in that case, you're talking of entity risk. Then you also have a sectorial risk. So in that case, businesses within a particular sector are exposed to certain unique risk, the risk unique to that sector. Then you have a macroeconomic risk, which has to do with factors outside your control. Take, for instance, the issue of Naira devaluation. It was a macroeconomic risk. Like I said, banks had given loans that were within their single obligor limit. And then the value of Naira tripled or quadrupled. And then, the value of dollar quadrupled. And then what they were holding there for 400 Naira became 1,600 Naira. And then the loans ballooned in value. The Naira value of the loans ballooned. So in that case, you wouldn't say the banks did not do their risk management properly. But of course, there are mitigants that could have been built if we have a more robust economy. They could have entered into forward deals, but even the forward deals, we are not honored after that. So the key thing is that in managing risk, there are multiple layers of risk management, like from institutional risk or individual corporate risk, sectorial risk, and then you talk of the macroeconomic risk. Banks are supposed to evolve a risk management framework that would take cognizance of this and build mitigants against them or do scenarios of things go wrong. But reality of life is that the future is unpredictable. No matter how wise you are, how well you plan, you will still suffer risk. And that's why that asset class is called risk assets. Risk assets, which means the inherent in that asset is high level of risk. And what the banks do is they price in the riskiness of the individual institutional borrowers as well as the sector they belong to in lending to them. So I wouldn't say the banks are not doing a good job. If you look at the non-performing loan ratio of most banks, they are in the region of 5-6%. Of course, if they throw in this forbearance, those non-performing loan to total loss will have increased materially. But we must recognize that the macroeconomic environment is challenging. But having said that, the banks are still required to continue to improve their risk management framework to mitigate to the highest level some of the risk that they are exposed to.
What does it mean for the larger economy and for basically Nigerians when CBN comes up with initiatives like this one? What does it mean for us?
Well, for the larger economy, it simply means that the banks are going to curb the loans they are granting, the size of loans they are granting. I know the bank that one of the business I am involved in relates with or borrow from, they wrote them to say, look, we can no longer grant you unconfirmed letter of credit unless you have bought $1. So what that means is that the banks are pulling back on lending. If banks pull back on lending, it has a dampening effect on economic activities because the level of transaction that business operators can do will be highly limited if they have to do with their own capital. So it has a dampening effect when banks are going to hold back on lending as a result of the need for them to, one, restore existing capital, clean up their books, because the central bank has also requested that they can quickly write off those non-performing loans, particularly loans that have been fully provisioned can be written off within a year instead of waiting for 1 year to see if it could be recovered. And then the central bank wants them to do asset sales. You can't be doing asset sales and at the same time creating new risk assets. So we should expect a slowdown in lending activities from the banks, which will have a negative or dampening effect on economic activities.
But generally, we've also seen the IMF come to commend the Apex Bank in recent times, talking about the stability we've seen in the FX space, stability of the currency and all of that, tight monetary policy. In your view, how would you also react to what the IMF has said, and what more do you think is expected of the central bank at this time to help stabilize the economy, of course, in its entirety?
Well, what I would say is that the MIF is right. The central bank, the current central bank management is doing a lot of good job, or has done a lot more better than the previous central bank in terms of use of macroeconomic monetary tools, which is that the two monetary policy tools to manage price levels, particularly exchange rates. We've seen a central bank that has been quite bullish, quite aggressive in the issuance of treasury instruments, OMO, and treasury bills. As at the last count, as at this today, central bank has raised about 15 trillion naira through OMO and treasury bills. Most of those funds were to attract foreign portfolio investment, help generate foreign currencies, and which was used to intervene in the market and stabilize the exchange rate. So you can actually say, of course, it comes at a very high cost. The central bank at the last auction discount rate was about 18.8% or so, which gives you effective yield of more than 20%. It's coming at a higher cost, but then it's achieving the objective of stabilizing the exchange rate. In terms of what else can they do, the reality about managing the economy is that there is just, to an extent, what the monetary policies can achieve. Then you need the fiscal policies to drive economic growth. Monetary policies will at best are designed to maintain price stability. Fiscal policies are designed to drive sectorial and industrial growth or economic growth. So we need the fiscal policies to complement monetary policies, because the reality is that no economy will ever develop as a result of effectiveness of monetary policies. It will be driven economic growth and development are driven by fiscal policies. And then if we have more complementarity coming from the fiscal side, then the effectiveness of monetary policy will be more pronounced.
Will really be more pronounced. Well, finally, before I let you go, again, the stability of our banks is something that everyone will talk about, because when the banking sector is, when there are issues with the banking sector, everyone will be worried. What do you make of the stability? And as they move on for the recapitalization, which is the big one, what are your expectations?
I think the Nigerian banking system is quite stable. There is no major systemic risk. There may be one or two weak entities that are still operating. But in terms of systemic stability, I think the Nigerian financial services sector, particularly the banking industry, is very stable. In terms of capitalization, I think they are well capitalized. Look at the solvency ratio, look at the capital adequacy ratio, they are well capitalized. Going forward, I believe that in the Tier 1 banks are likely going to all meet the capital requirement, the new capital requirement. I think a reasonable number of Tier 2 banks are going to meet that capital requirement. Some of the newly licensed banks that have not been in operation may consider either downgrading to regional banks or merging with other national banks to remain in operation. But I think the tendency, given the tendency of Nigerian ownership, they are likely going to downgrade to regional banks and grow back into national banks. So we should expect some level of adjustment in the number of national banks. I think that's where the adjustment will happen. For the banks that have international operation, if there's going to be adjustment, maybe one may fall out of that category, but it's possible that the 7 of them will meet the capital requirement of 500 billion naira to remain, to retain their international operating licenses.
Again, go ahead, please. Go ahead, Mr. Chukwu. Go ahead.
Another challenge they will have to deal with is the requirement, the CBN directive of June 13th, that said there won't be any further investment in foreign entities, and there won't be any payment of dividend, and there won't be any bonus payment to directors and management staff until the banks meet the capital requirement, or until they unwound the forbearance. So that might constrain them coming to the market, particularly those who have not done that, to raise additional capital, because the pricing of those shares may not be quite attractive to them to raise funds, or attractive to investors to take up those shares if they have not already concluded their plans to meet the new capital requirement.
Again, before I let you go, Mr. Chukwu, some are worried that this move might also a bit tighten the access to credit. Is that a concern?
Yes, I think I alluded to that in my earlier comment.
Okay.
Yeah, with the central bank directive, the impact on the economy is that banks are going to limit their lending. And I gave example of where a lender to one of the companies I'm involved in had actually sent a letter to them on 2nd of July, indicating some constraint in the utilization of an existing line that the company already enjoys.
It's a good way to leave it. I must thank you, as always, Mr. Johnson Chukwu, for joining us far away, Owerri in Imo State. Thank you so much for your time. And do enjoy your stay, and we expect you back in Lagos very soon.
Thank you for having me.
Thank you, Mr. Johnson Chukwu.